Welcome back, everyone. Today we're going to cover Chapter 7, which is the Accounting Information Systems. Throughout the semester, you have learned various accounting techniques to record transactions, and these techniques represent a manual method of accounting. And small business owners often focus on product sales and often forget about accurately keeping track of the financials. So, the techniques and the scores are valuable to you as tools that can help the small business owner keep track of their financial history. Depending how fast your business may be growing, keeping track of financials manually can become a full-time job without much time for anything else. So this is where small business owners can use or take advantage of using a computerized accounting system. And there are many popular products available for small business use. One of the most popular is QuickBooks, that you may be familiar with. It not only keeps track of sales, but it also is capable of keeping track of inventory and generate purchase orders to resupply your inventory. And it can even do advertising. It has an advertising option. So for many businesses, computerized systems are a better option based on convenience and expense costs. So it really needs to outweigh your pros and cons. For others, the cost is not worth it and a manual system is preferred. So you may be wondering, why learn the manual accounting methods if I can get a software program to do it for me? I believe that it is important that the business owner knows the manual methods in order to be able to understand what the software is doing. So the owner can understand the financial statements that are generated and be able to interpret the information. Also, like any other technology, there's a chance of system failure. So what will you do in the meantime while the system is not working or it's unavailable? Just like a calculator can add, subtract, multiply, divide for you, and even some calculators can compute calculus problems. There are very high-tech ones out there. But what do you do if you do not have a calculator? It's important that you know how to add, subtract, multiply, and divide manually and get the work done even when technology is not available, correct? The same thing here with the accounting methods. Your business must keep on moving forward even when QuickBooks is not going to be available. So, let's see what I have here. The advantages of a computerized accounting system is that it eliminates many errors that can occur as a result of human error, and it provides up-to-the-minute information which can result in better business decisions. Okay, so now you know that there's two accounting systems, either the manual or the computerized. And most businesses use computerized accounting system now that the technology is evolving and it's readily available. But computerized systems differ from entry-level software to enterprise resource planning systems. So there are many choices out in the market when it comes to choosing a software package. And I'm going to skip this because this says... I already talked about a little bit about this. So the accounting information systems are going to collect and process transaction data and communicate financial information to decision makers. So I touched a little bit on that when I said that it's very important for you to understand what this program is doing so that you can interpret the data. And the softwares include every step in the accounting cycle. Okay, and what's important is that it's a software that's going to keep evidence of transactions for you. They're going to keep records. There's going to be trial balances. It's going to keep track of worksheets and financial statements. It's all in one spot versus the manual system, where you may have different documents at different locations, or worse yet, you just have paper pencil tracking, and it may get lost. So there are many choices out there in the market when it comes to choosing a software package. For small businesses, it is recommended to find an entry-level software like QuickBooks. And small businesses are considered to be companies with less than $5 million in revenue and with up to 20 employees. So as you can see, QuickBooks will cover a huge chunk of the market because we have small businesses that range from 1 employee to 2 employees that probably generate under $100,000 a year, to what we have here where it could go up to 5 million with up to 20 employees. Okay, these programs control more than 90% of the market, and they're designed for restaurants, retailing, construction, manufacturing, or nonprofit. And they're used by companies with revenues, however, said that it's up to 5 million and after 20 employees. Okay, some of the features is that it's easy data access and reporting preparation. It has documents readily available with history for your audit. It has the internal control. You could customize it based on what your needs are, and then you have the network compatibility. Now, for large businesses that have more than 500 employees and more than $5 million in sales, it's recommended to look into more sophisticated systems known as the Enterprise Resource Planning or ERP systems. And one example is Oracle. These softwares integrate all aspects of the organization, including accounting, sales, human resource management, and manufacturing. So, to give you the perspective of where I work, I work in an institution. We have an ERP system that has a student component where there's information housed for all student information, what classes they're enrolled, what their grades are, how much they owe. There's also the finance module where, there's supplies that need to be purchased, whether that's for the classroom or for programs that are offered on campus. There's also the human resource component, and that tracks all the employees that are in the organization. So education systems also use an ERP system. Obviously, they may not have $500 million in sales. They're more in the middle range. It's not a small business or it's not a manufacturing company, but it is complicated enough, and it has lots of millions of dollars to deal with, where it can benefit from an ERP system. So even though there are programs out there that can do what we are learning this semester, I have a job to do, which is to continue showing you the manual accounting method. And you have a benefit of learning it, so that whether you're going to go run your business or not, you have the tools to be able to run it in the manual system. So we still have a few tricks to learn. So one of those concepts is the subsidiary ledgers. So you learned about general ledgers back in chapter 2. You first posted transactions in the general journal, which included transactions for all accounts in chronological order. And if you need a refresher, go back to chapter 2 or listen to my lecture for that chapter. And from the general journal, you posted the entries into ledger accounts. That would be the cash account, the liabilities account, the owner's capital account. And basically, you transferred all transactions that dealt with cash accounts into one general ledger. Okay? And you named it the cash general ledger. And you continue with the same process with other accounts, like the liabilities or the owner's equity account, and you posted those in one central location for for those particular accounts. So what is the difference between a ledger account and a subsidiary ledger? So when you transfer the postings from the general ledger to a ledger account, you transfer the transactions from many companies or customers into the same ledger account. So to explain this, let's think about the accounts receivable. Okay, remember that accounts receivable is what customers owe the business or company when the customers order something with a credit card, and so your business has not received the cash. Okay, that's what accounts receivable means. So let's say that your business is a supplier's company. So the function of your business is to provide supplies to different companies throughout California. Okay, I'm trying to conceptualize this for you so you understand what this concept is all about. And every time a company orders a shipment, they don't automatically pay up front. Okay? You assume, or you run your business assuming that they are going to pay you 30 days later after delivery. So if you keep a general ledger to post these transactions for all the different companies that are ordering from you, it's going to be extremely difficult and time consuming if at one point in time you want to know how much company X owes you, or how much company Y owes you, or how much company Z owes you. Imagine if on a typical day, hundreds of companies order supplies from your business. That means that possibly thousands of records are posted every month. And that means that you have to go through all of those thousands of records to determine how much company X owes you at a particular day and time. Okay? So that's a daunting task. So how do we simplify that? Well, we can go one step further from the general ledger and create subsidiary ledgers from the account ledgers. Okay? And we do that by separating the postings separately for each company. So this allows us to know how much company X owes us at a point in time. So notice that on this illustration, the accounts receivable and accounts payable are known as control accounts. Okay? And also notice that cash and owner's capital in blue is not a control account. This is because there's no subsidiary ledger accounts related to these accounts. Okay? So these are what you know when you posted general ledgers for accounts receivable, you did it in general terms. So if customer A, B, and C order from you, you posted that every time customer A orders something from you. Maybe the next line was that customer C orders something from you, and then customer B orders something for you. It's not in any order except it's in chronological order from when you receive the orders, when you have to fill those orders. Okay? But it's not ordered in any way or shape or form in terms of each company that ordered from you. The subsidiary ledgers do that. It's going to take it one step further and organize all the transactions that deal with one customer or one company in one location, and all the transactions that deal with another customer or another company in another section. I hope that this visual helps you. Same thing with accounts payable. You owe companies money. Perhaps you have a line of credit that you use to order the supplies that you're reselling. And you order them from 3 different companies, okay, through this line of credit. So that's why they're called creditors X, Y, and Z. You could put it in the control account or the general ledger every time that you order something. But if you want to know at one point in time how much money you owe one particular company, again, it's going to be a daunting task. You're going to have all these transactions in one place, and it's not any chronological order in terms of companies. It's only in order of the orders on the dates that you submitted orders. Okay? The subsidiary ledger allows you to arrange all of the transactions with creditor X in one place, another place for creditor Y, and another place for creditor Z. Now, this illustration shows you the relationship between the general ledger and the subsidiary ledger. In the previous chapters, you learned that on January 21st, you purchased something, so you recorded it, either as a debit or a credit. Okay? Now, what you do is anything that deals with a certain company, you transfer it to that particular subsidiary ledger. In this case, we have the airing company, the branding company, and the caring company. I hope that's how you pronounce it. So you have 3 subsidiary ledgers to represent postings from 3 companies and the balances for each company. So you know that Aaron owes $2,000, Brandon owes $0, and Karen owns another $2,000. And between these 3 companies, there's a total of $4,000 owed to the business, to your business, which is also reflected on the general ledger. Just in general terms, see? On January 31st, so there's a balance of $4,000. So this is like a summary version, you could say, versus the more details based on companies. So what are the advantages of subsidiary ledgers? They show transactions affecting one customer or one creditor in a single account. And it frees the general ledger of excessive details, because now you don't have to post every single thing in the general ledger. You're going to see in the next few slides that you can actually just post transactions maybe perhaps once a month to reconcile what you have on each of the subsidiary ledgers. And it helps locate errors in individual accounts. It's hard to figure out what went wrong when you have thousands of records to go through, versus you know that one company is not balancing out based on your records, so you go to that company and try to see what the error is or where it's located. And it makes division of labor possible. Okay, so when you have many similar types of transactions, such as credit sales, companies use special journals. Okay? And special journals allows the possibility to divide labor within a company. So in this illustration, we can see 4 types of special journals. We have the sales journal, we have the cash receipts journal, we have the purchase journal, and we have the cash payment journal. And a company can choose these as special journals because this particular company may have hundreds of daily transactions for each of these accounts. So if a company chooses these 4 as special journals, then 4 different offices or individuals, depending on the volume of the transactions, can divide the work. So one person or one office can be in charge of recording the sales journal. Another person or another office can be responsible for cash receipts, and so on. So if a transaction needs to be recorded that is not one of the 4 that are identified here, then it would be recorded under the general journal. Okay? As usual, as you had learned before. Now, one thing to note is that a company may choose different or similar accounts and identify them as special journals, okay? So just because I am showing you these 4 categories here as special journals, it does not mean that those are the only possible options. It all depends on the business. The type of business that it is will determine the type of accounts that will be affected the most on a daily basis, and those companies may choose different journals, special journals, okay? So I'm going to show you visuals, and these are in your textbook, so they may be a little small for you to see. Okay, so go back to your book and refer to these visuals and re-listen to my lecture if needed to make sure that you're understanding what I'm trying to say. Okay, and I'm going to check out of the presentation so that I could blow it up a little more. Let's see. I hope this helps better, okay? So here's a sales journal for different companies here. We have Abbott Sisters, Babson Company, Carson Bros, Deli, and so on. Okay? If you remember back in the previous chapter, when we recorded sales on a perpetual inventory system, we had to post two transactions, one for the sale, the amount of the sale, and the amount of the cost of the good that was sold. Okay? So think that you are selling, we're going back to the same example, you're selling supplies and you sold $10,600 worth of supplies to Abbott Sisters. This is where you would record it. You would record the date of the transaction, the account, in this case the name of the company, the invoice number, and you would put in the total amount of your sale for that invoice. But then you would also have a separate column that would record cost of goods sold. So you know that the $10,600 that you sold in supplies actually only cost you $6,360. And you continue to do that every time that you sell something to some company. Okay? And this shows you the relationship to the subsidiary ledger. Notice that here you have different transactions for Abbott Sisters. On May 3rd, you sold them something, and on May 21st, you sold them some more. Okay? So what you do in the accounts receivable subsidiary ledger, you are going to record exactly what happened, whether it's a debit or a credit. Notice that there's no debit or credit up here. Okay? And then you know, because of your lovely subsidiary ledger, that for the month of May, you sold $26,000 worth of supplies to Abbott Sisters. Likewise, you go through the other companies, you record them as they're being sold to you, but then you separate them based on companies. So you know that Babson Company, you sold them $29,920. Does that make sense? Now, what is the relationship between the subsidiary ledger and the general ledger? The difference will be now, every time throughout the month of May, when you make a sale, you're going to record that based on the company that you sold it. Maybe you have different employees in charge of different companies, okay? But for the general ledger now, you're not going to be posting it every time like you learned before, that if it affects one account or the other, you write it on the ledger, okay? You don't do that anymore on a daily basis. You're going to leave the general ledger to probably do it once a month. So you're probably going to only record something for the month of May, for the month of June, and so on. So at the end of the year, you only have 12 lines that you look at your general ledger. The details are going to be in your subsidiary ledger. So notice here that accounts receivable, we see that on May 31st, different companies owe us. We have a total of $90,230 that are expected to come in cash at a future date. Where did that come from? Well, if you follow the arrow here, We sold all these supplies to all these different companies on these different dates, and at the end of the month, they added up to $90,230. That's where it comes from. So this is a more detail without any chronological order except when the sale happened. The subsidiary ledger separates everything depending on each company that you sold it to. So this has more detail, and at a one given point in time, you can refer to this and say, okay, I sold this much to this company, and as of this date, they've only paid me so much. Okay? You could do the same thing for inventory. Okay? You'd know that for the whole entire month, you sold all this supplies to these companies, and it only cost you the amount that you recorded on cost of goods sold. And at the end of the month, you know that the entire $90,230 that you sold, it only cost you $62,190, and you know that that's part of your inventory that you have to decrease now because it's gone. So that's why you credit it on the inventory ledger. And you can see the pattern here. You could put it the sales revenue here and the cost of goods sold here. So I hope this conceptualizes and shows you visually what the relationship is for the sales journal. Okay? Now, that was 12. Okay, so similarly, we do this with cash receipts journals. Okay, but notice one thing that we have it's a different spreadsheet. Okay? When you have cash receipts, you want to record the cash that you received, the sales that you provided. Are they owing you some of that money through credit? Okay? So, and then you also want to have the cost of goods sold. So it's just a different way of recording it in a more easy format for you to refer to. Then, similarly, like the previous sample, you have your subsidiary ledger and then you have your general ledger. Okay? And last is the purchase journal. Sorry about that. My computer is a little slow. It's not reacting fast enough to what I'm trying to tell it to do. Purchase journals also has a different way of recording it. When you purchase something, all you want to do is who you purchased from. You want to record that, from which company you purchased it from. What the terms of the payment will be. Remember, 210 net 30 means you get a 2% discount if you pay them within 10 days. Otherwise, you have 30 days to pay them. And how much inventory that is. And then you conceptualize that into the subsidiary ledger and the ledger. That's all that it is for this chapter. That's what it's trying to tell you, or that's what you should get out of. So, your homework assignment is going to focus on the subsidiary ledgers. I need you to grasp what this means. Okay? So I'm going to give you a homework example that is going to be extremely similar to your homework assignment. So we have X, Y, and Z company that has a balance in its accounts receivable control account of $20,000 on January 1st, 2017. Okay? The subsidiary ledger contains 3 accounts. Food company with a balance of $4,000, clothing company with a balance of $3,600, and the shoe company, we don't have a balance. But we should be easily able to determine that because we know that the total on the accounts receivable is $20,000 between these 3 companies. Okay? Now, the following transactions occurred with these companies. There was credit sales for $8,000 for the food company and collections of $7,000 and 0 returns. The clothing company has $7,000 in credit sales, $3,000 in collections, and $4,000 in returns. And the shoe company had $7,500 in credit sales, $8,000 in collections, and $0 in return. So the first question is, what is the January 1 balance in the shoe company subsidiary account? Well, here's the answer, and I try to do it as detailed as possible so you can refer back to it when you do your homework. The accounts receivable control account in its entirety for all three companies is $20,000. That was given to us early in the problem. And we know that the subsidiary ledger balance for food company is $4,000 and the clothing company is $3,600. So in order to find the balance for the shoe company, we do the simple subtraction. So we take the $20,000 minus the $4,000 for the food company minus the $3,600 for the clothing company, which gives us a total of $12,400. So the balance for the shoe company is $12,400. Pretty much straightforward, okay? Questions 2 is, what is the January 31st balance in the control account? What is the January 31st balance in the control account? Well, we know again the beginning balance of the control account. It was given to us at $20,000. Okay? And if you go back to slide 16, we're giving this information here. This is where I'm taking it from when I'm explaining the answer here on this slide. Okay? What we need to do is find the balance for the account at the end of the month by doing the following. So, the balance of the control account, we take the beginning balance of the control account, which is $20,000, and then we're going to add the credit sales for each company. So if you look at the credit sales for each company, it's $8,000, $7,000, and $7,500. This is where it's coming from. So it's $20,000 plus $8,000 plus $7,000 plus $7,500. And then you're gonna minus in the collections for each company. If you notice, the collections is 7 plus 3 plus 8,000. So we have 7 plus 3 plus 8,000 minus any returns. And if you go back to the slide, we only had returns for clothing company for 4,000, which is why we have 0 plus 4,000 plus 0. And if you calculate all that, you'll see that the balance of the control account is $20,500. Okay? And the last part will be compute the balances in the subsidiary account at the end of the month. And you will do that by following the same steps in question 2, except you do it for each company. We did it for all three companies here. You're going to do the same thing, but now you're going to do it for each company separately. Okay? And the last question is, which January transaction would not be recorded in the special journal? And the answer here is sales returns. Okay? Sales returns. And it will be recorded in the general journal instead. Okay? And that's it for your chapter 7. Let's see if I could show you the homework assignments. You have your usual lecture assignment based on the readings. This week you do not have a quiz. Okay? But you do have a homework assignment, and is similar to the problems that I just described to you in the slides earlier. It's 2 problems. Remember, you have different numbers than I do. And it's giving you the balances on the accounts receivable account on a certain date, and it's telling you how much each company has for the beginning balances, and then it tells you that what happens during the month in terms of credit sales, collections, and returns. And it's going to ask you for the balance of one company. It's going to ask you for the balance of the control account. And it's going to ask you to compute the balances for each company at the end of the month. And it's going to ask you to identify which will not be recorded as a special journal. And similarly for 7.5, it's the same thing, just a different problem. I did not want to give you a quiz. That was going to be redundant, so no quiz for this week. We have 2 chapters left after this. So after this chapter, we're going to take a test, number 3. And then after that, we cover chapter 8 and 11. And that's all that we're going to cover for this course. So we will be working on the project pretty soon. Okay? And take the final and call it a spring semester. So I hope you're enjoying the concept so far. And I hope it's been helpful for you, whether you're going to start your business or you are going to work for a company. Good luck to you. If you have any questions, let me know.